Good day, ladies and gentlemen. I'm pleased to welcome you on behalf of TCI Express and SKP Securities to TCI Express Limited's Q2FY25 result webinar. We have with us Mr. Chandar Agarwal, Managing Director, along with his colleagues, Mr. Muktilal, CFO, Mr. Hemant Srivastava, COO Surface Express Business, and Mr. Ashok Pandey, COO Multimodal Express Business. This webinar is being recorded for compliance reasons, and during the discussion, there may be certain forward-looking statements which must be viewed in conjunction with the risks that the company faces.
Yes, ma'am.
I now hand over the webinar to Mr. Agarwal for his opening remarks, which will be followed by a Q&A session. Thank you, and over to you, Chandra.
Thank you. Good evening and a very happy Diwali to everyone. Welcome to the Q2 and H1 Financial 25 earnings conference call of TCI Express Limited. Thank you for taking the time to join us today. We have already circulated our earnings presentation on the website and stock exchanges, and I hope you've had a chance to review it. I will start by providing an overview of the business trends we encountered during the quarter and the steps we are taking to ensure long-term growth and value for our stakeholders. Following that, I'll hand over the call to our CFO, Mr. Muktilal, to walk you through the presentation in more detail. TCI Express showed modest improvement in revenues and maintained its margin sequentially in Q2 Financial 25, reflecting the company's efficient operational strategies, innovative service offerings, and market adaptability, strengthening its position as India's most trusted and fastest growing
Sorry,
express
Chandra sir,
delivery
your
company.
voice is...
Friends, we'll
A
just interrupt
year-on-year
you for a
revenue
minute.
saw a slight dip due to several factors,
Ch-
including prolonged monsoon rains,
Chandra, apologies, I need to interrupt you
that
for a
led to
second.
water
Yeah.
logging and flooding,
Uh,
causing supply chain disruptions and delivery delays. Additionally, lower activity in manufacturing and automotive sectors, coupled with geopolitical tensions, softened the logistics demand.
Friends, just give me a minute. I think there's some technical issue. Bear with us for a minute. We're just fixing it. Thank you. Friends, give us a moment. We're just fixing this audio issue. Thank you. Friends, apologies for this audio glitch. Just bear with us for a moment. Friends, Mr. Chandra Agarwal is having some technical issue, so we'll have Mr. Mukti Lal, the CFO, to take over. Mukti, please go ahead.
Yeah, so good evening, everyone, and apologies for that. So good evening and very happy Deepavali to everyone. Welcome to the Q2 and H1 FY25 earning calls of our company. Thank you for taking time to join us today. We have already circulated our earning presentation on the website and stock exchanges, and I hope you have had a chance to review that. I will start by providing an overview of the business trends. And then I will be going through with the presentation. And so TCX was in this quarter showed a modest improvement in revenues and maintained its margin sequentially in Q2, reflecting the company's efficient operational strategies, innovating service offerings, and market adaptability, strengthening its position as India's most trusted and fastest growing express delivery company. However, year-on-year base revenue saw a slip dip due to several factors, including like prolonged monsoon rains led to waterlogging and flooding, causing supply chain disruption and delivery delays. Additionally, lower activity in manufacturing and automotive sectors coupled with geopolitical tensions softens logistics demand. So amidst these challenges, TCI has advanced on multiple fronts. Our rail express service is gaining traction with the customers, contributing positively to margins, and is essential as we aim for the multimodal services to make up like 20 to 22% of revenue over the next 2 to 3 years. Automation remains a key focus, exemplified by our newly automated Pune sorting center, which has improved operational efficiency and reduced turnaround time by almost 40%. We are extending automation to our next automation to be like Ahmedabad and Kolkata center to better handle increasing volumes. This year we introduced a money bank guarantee, reflecting our confidence in timely delivery across surface, rail, and air modes. This offering has been well received by customer and strengthens our position in express logistics. We are honored to receive recognition, including the Iconic Brand of India 2024 and the Rajasthan Business Award for Best in Logistics. And we are humbled to be named Mr. Chandar as an ET Business Leader for 2024. We are pleased to say that we announced our first interim dividend for this year as a 3 rupees per share, which is 150% on face value. This reflects our commitment to creating value for our shareholders and shows our focus on steady growth and profitability. On our CSR front, we formed TCI Express Foundation and opened our first Jaipur Food and Rehabilitation Center in Lucknow, offering free artificial limbs and other adds to like almost around 100 individuals so far in within a two-month time. And the PD Agarwal blood donation drive 2024 also saw 1,334 participation nationwide. Now, as we move into the second half of FY25, we are optimistic about the future. We anticipate a recovery in demand with the upcoming festive seasons. TCI Express remains steadfast in its commitment into leveraging its strength, seizing growth opportunities, and maintaining a customer-centric approach. So now, we can start with the Navinji. We can start with the presentation, please. So I will give you brief for that.
Sure. Yeah. Just give me a minute. Mukti, is my screen visible?
Yeah, it is visible, please. So this is our synopsis, we completed it. Yeah. So good evening, everyone, again. So this is our synopsis of our company. We demerged this division from the TCI and almost 8 years completed. And our business of offerings 97% is B2B and 3% of B2C. And we are serving 60,000 plus location. Next, please. So I'm just gone through with the things. This is our USP where we continuously following asset-light business model, even in multimodal express also. We don't have any franchises. We carrying high-value cargo and low volume. So this is a high-margin business. And we continuously, need the low working capital requirement in this business. And it is still keeping within less than 20 days in net working capital requirement. And still, I think you have like gone through with this presentation. So we have the lowest cost structure in this industry. We are expanding our multimodal services, and we also like IT is very important for our kind of business, and that's why we also focus on a various aspect, including API. We dealing with the customer and getting the automated data, and then also like track and trace facility also, and so various things we are doing. And completely trucks having like containerized movement, and yeah, please. And our USP to be continuously focus on this automation. So yeah, next please. So this is the second automation we completed in Pune, and this is also seamlessly we integrated the system, and now their turnaround time has also been reduced in the range of like 30 to 40%. Service offerings are like as the same what we have discussed in last quarter, please. Yeah, next please. So this is Rail Express. So I just would like update here. Rail is really growing very fast, and now we have the 5,000 plus customer base in this segment, and we almost our route we present on around more than 150 routes, and it is increasing day by day, and it's a good thing. Like repetitive customers is giving the business to us, and is a good profitable, and is a like midway of surface express and air express, and giving the same kind of turnaround time which we giving in air services. So customers are very happy, and we are expanding very well. Yeah. This is C2C, so it is also like growing on a steady path, but on a slower growth, and not like in a growing like rail is growing. Yeah. Yeah, please, we can skip. Yeah. Money bank guarantee, just we like giving updates. So it is also we giving this service to all modes of the transportation like surface, rail, and air. And this is also customers. It is basically for meet for the like new customers or one so that's why is attracting the customer and giving like, then we can be they can be rely upon our services, and then can give the repeat order for that. So it is also getting very good traction from the customer. Next, please. These are the like Q2 highlights. So we have achieved an income all around 314 crore rupees income, and EBITDA is around 40 crore. PAT level has improved as a sequentially, so from like 23 crore to 26 crore, and we declared a dividend of 3 rupees in this quarter. And in this quarter, this quarter, our capacity utilization of the whole fleet is 83%, and in last quarter it was 82%. So average out it is around 82.5%, which is still below like expected numbers, where we want to be improve at least to achieve level 85%. So once the volume will be like start to normalize, then we will be achieve 84 to 85% again. And although like industry vertical, so still automobile and lifestyle product and some engineering companies still facing the challenges on a demand side, and overall consumer demand is still weak, though we have seen some uplift in the demand in quarter on quarter basis, but on year on year basis we have still like flattish numbers, and industry is also in the same way. Yeah. Next, please. Yeah. So there is enough. This is the like income we show on the quarter wise, where we in Q2 of last year we achieved around 322, and now we achieve 314. So it is around negative by 2%, and that's why it's also impacted margin because. But good thing is that our operating margin is intact, and is or you can say like hit by 150 to 200 basis point, and EBITDA margin has also like bring from down from like 16 to 13% due to like other cost, salary, and some admin cost has increased. Yes, please. Accordingly, once we this volumes is coming back, then we have to be, as earlier we in past we did like whenever we achieve a growth, then we have to be 2x of that we are earning on a profit margin. So same way, if you see from quarter 1 to quarter 2 story, like where our revenue has grown 6% and profits has grown almost 14%. Yeah. These are the H1 highlights. So total income is 610 crore rupees and EBITDA is we achieved 76 crore and PAT is near to 50 crore rupees. In this, yeah, please. Yeah, next, please. Yeah, next, please. So this is the dividend side. So we internal policy, we had to be like given almost in the range of 20 to 25% or as a dividend payout ratio. So we will be in the same path. In this time we are given again 3 rupees, and I think overall by year end we will be maintained the ratio of in the range of 20 to 25%. Return on capital employed. So we slightly work out on the only core assets. Like non-core assets means basically current investment and like office land we bought, that we have removed from that. And if you see, so there is like operational ROC, if you see, it is like in this H1 is 12.5%, and for the whole year we will be achieve around 30% plus, which we earlier achieved. So all numbers are excluding core assets. And same return on equity is the same. It's pure on the number, and in this H1 it is almost 7.5%, and last year it was around 11%. Cash conversion ratio is again robust, so there is no challenge on that side. Usually in H1 is low, and then full year is always like in the range of 70% plus. Next, please. Yeah, it's the same as I mentioned. So on capital expenditure side, we spend almost around 11 crore rupees in this H1 because unfortunately, we were not able to crack any land deal which we anticipated at either on Bangalore or Chennai or Mumbai. We were not able to get that. So that's why capex is on lower side. And we also yet not started the construction at Kolkata and Ahmedabad. That we will be soon we will be start for that. Next, please. This is a leverage profile. There we like receivable days, as you see, is maintained at 55 days, and payable days is in the range of like 33, and accordingly net working cycle is 22 days. So it's a very robust profile we have, and we are keeping continuously as a debt free company status. Yeah, this is a balance sheet. So balance sheet, you compare with the H1 of last year to this H1. So whatever added, this is a capex, and ultimately is added like around 40 crore rupees. So basically, it's conversion from work in progress to in capitalization part, and less is, I think, is a normal one. Same way, current assets are also increase. So basically it is increased because current investment surplus fund has been increased. So basically 45 crore increase is contributed by that only. And on equity side, there is an all liabilities and current liabilities are all the same. So whatever we earned as a profit is added to that. Nothing significant on that. Yeah. So these are comparison with the peer. In spite of our margin has taken a hit, and in H1, in spite of that, in Q1 even that was the I think lowest in margin level. So in spite of that, we are still ahead with the other industry players in the margin profile. Yeah, that we can be skip. Is there nothing new on that we discussed earlier? So strategy outlook will be continue to we will be more focused on to grow this multimodal services. So we'll keep that. On capex side, we plan for the as mentioned earlier also FY23 onwards we have a capex plan of 500 crore rupees, and till time and almost on a 2.5 year we spent almost near to 200 crore rupees or 180 crore rupees, and remaining 300 plus crore I think we will be spending in the next 2.5 year, and majorly will we again go to sorting center automation and IT improvement and all. So that would be the path ahead. Yeah, we can be skip that. Yeah, that can be speak. So again, growth drivers for the logistic industry is also like heavily depending on the manufacturing in India, and key changes like focus on sustainability is very important. That is growing in India because logistic industry is giving highest carbon emissions. So we have to be cop with that, and we taking so many steps to be how we can be like carbon neutralized given in our like sustainability report. And second, we will be keep continuing focus on multimodal services. Infrastructure development is very important, how it will be placed, because cities are like choking and we are really having, like weather conditions is also like giving some threat to be this business in time to time. Yeah. Yeah, please next. This is our leadership team. Yeah. So this is like we put this slide for your like consumption here, how this overall logistic industries played in like H1. So you seen transportation cost is persistent inflation, is really led to higher transportation cost, and because two component is very important here. One is toll tax and another one is labor cost, because as volumes are muted, so basically we have to be bound to be increase the labor cost and toll, and this is all not mitigated by the like volumes, and that's why is impacted profit margin to every industry players. And another thing you have seen continuously is a decline in manufacturing output. This is PMI is like slightly down, and this is also seen like consumption of fuel was not happen. It is like flattish in this H1 over the last year same H1. And weather condition is also like setback to the overall logistic industries, heavy monsoon and the things. Yeah.
Mukti?
Yeah.
Yeah.
This is also like some broader. So this
Mukti,
is the, yeah.
We lost you there for the last
Now it is
1 minute.
okay. I am
Yeah, yeah.
audible. Yeah.
Yes, you are.
So these are the again few numbers which we as a broader points for this industry. So vehicle sales has also like down or having like very low growth, and so that's why the cost concern and used vehicle demand has slightly rise, and diesel consumption, as I mentioned, is hardly 1% growth of over last year same period. And so I think demand would be in a like guidance factor. So demand would be in a, like in the similar way, in the not be like in not be much one, and I think moderate one, may not be grow in a mid single digit kind of growth we may be achieving like in second quarter, in second half basically. Next please. These are our ESG initiatives. Yeah, please. Yes, please. These are the award and recognition I just mentioned on that. Yeah. Next please. We like ICRA and CRISIL has reaffirmed our ratings as again AA minus by CRISIL for the long term, and ICRA is getting like A1 plus, which is the highest one for the short term. And we also keep like certified great place to work for the is for 24-25.
Mukti?
Yes, Navinji. So I am audible now?
Yes, now you are. Should
Yes,
we
please.
open the floor for the Q&A session?
Yes, please. Already too late. Yeah. Due to some these technical glitches are there.
Yeah,
Yeah.
yeah.
No, please.
Friends, we open the floor for the Q&A session now. We take the first question from Janam Shah. Janam, please unmute yourself and go ahead.
Yeah, hi. Can you hear me?
Yes, loud and clear. Please go ahead.
Yes, yeah.
Yeah. Hi, sir. First on the volume numbers, if you can provide the volume for this particular quarter.
So volume is exactly 250,000 ton for this quarter and 485,000 ton for the H1 of this H1. In comparison to last year, same H1 is getting 492,000 ton, and in quarter two was around 252,000 ton.
Got it, sir.
That's
Got
the
it.
number. Yeah.
Got it, sir. Sir, on the branch addition, I guess we have targeted for around 50 branch addition. I guess in 1Q we have added 3 and in 2Q we have added 2. So what could be the guidance for the branch addition, and are we going intentionally slow in terms of branch addition given that volume is not picking up?
Yeah, this is true actually. So basically, we just muted that expansion of branches for the time being, because as the volumes is not picking up, so we wait and watch. Supposing to once we start to like getting the volumes, then we will be again expand on a very fast mode.
Okay. Sir, in the first quarter, there has been impact because of the Air Express business as well, wherein our margins has been squeezed during the 1Q. Has there been any impact in 2Q, or everything was settled in 2Q, wherein we have passed on to the cost to the customers?
Yeah. So basically, if you see this air business cost is also like impacted in Q2 as well, because that cost is still is on a high side due to the consolidation of airlines, and second part privatization of this airport, and third we also expanding direct network as I mentioned in last call. So that is going on, and because the cost has increased, but we were not able to passing on to customer, because in this high cost scenario customer is also not ready to accept that. So that is still continue in this quarter two as well for that. So overall, if you see that impacted in 100 basis point in overall cost, remaining cost impacted by like increase in toll tax and labor cost specifically, and third component to be like contributed in this increased cost is like a lower utilization of fleet, which is now in this quarter was around 83%. That's why if you see we able to reduce the cost by 70 to 80 basis point in sequentially.
Got it, sir. Got it. Sir, on the price increase side, so there have been few competitors which has increased the pricing from the July, and there have been few announcements that they'll be increasing from the January onwards, which is also in the range of 7-8% on an average. So have we done anything on the price increase, or we are just following the model that we generally follow of around 1 or 2% increase on a yearly basis?
I really doubt on that. What competitors and other industry players saying they will be like giving a one notice and they will be able to increase the prices. I have big doubt on that, because in this industry usually is not happening in that way. Rather, you have to be go like sundry. SME customer is possible to be have increase, but big customers, yes, it is not possible to. Though cost, whatever cost increase, that can be passing on specifically on diesel side. But in normal one, annual hikes is not possible to be giving by one notice hike. So we wait and watch situation. If they are able to, then is a good for the overall industry, because everyone is facing the continuously cost pressure. So I hope, but we have not yet taken any price hikes, and we will be try to be start that effort from the in last Q4 actually for that. But
Okay.
still, we are not really much optimistic about this price hikes and
Prices.
high inflation, John, and all, and muted volumes are there. So really, I do not expect to be any high increase on that.
Got it, sir. And so just last one question from my side. Our volume has been, as you said, 2.92 lakh ton versus 2.85 lakh. So it has been kind of a degrowth in the 1H. And overall, we have been targeting earlier 15% plus, then 10 to 12% last quarter, and now in the you can say a mid of single digit kind of a growth that we are expecting for FY25. This question is for the, like you can say, from next 2 to 3 years perspective, how we are seeing the situation. Our GDP growth of the India has been in the 6-7% range, and if we see that that particular growth is eventually coming down, then how we would be coping up with the competition? And if we are targeting to grow at 7-8%, what kind of market share gain we can expect, and what kind of thing that we are eventually doing to have eventually a growth momentum for next 2-3 years? Because overall last 2-3 years have been quite stable numbers, and there has not been any increase in the top line. And of course, we have been doing significantly good bottom line as compared to the competitors, but eventually that is also getting impacted. So overall, your view for next 2-3 years time?
Yeah, so as I said, like we grown in 22-23, we grown like 15-16%. So we are not this slightly, you can say, like not slow down, but it's like muted growth has been impacted, start to impact in the last year only, and everyone has the overall industry has that impact. And this year is also like we are also surprising with that, because sometimes customer is giving confidence and they giving like growth numbers, we will be give so much volumes to us, and ultimately we were not able to, they were not able to give the what they have committed to us, or they even, because they also have the same kind of problem where they trying to be grow, but they have not grown in spite of like September supposed to be very good month for the everyone, but that has not gone into that way. You also seen the like diesel consumption number and all. So this is like, I think it's a temporary thing again, but this year is full of challenges in two way. One is muted growth, and second part like cost pressure also. But I think hopefully in next year onwards, again we will be keep the same guidance for the growth of in the range of 13 to 15% as a volume growth, and 1 to 2% growth in a value. But and what is the like giving the confidence to us is basically like pipeline we creating. We're discussing so many customers, and customers is giving confidence, and they coming to us, and we expanding this. We already have opened up the branches like in last 4-5 years, almost 300 200 plus kind of branches. So these all we are ready with that. Operational efficiency is also fantastic. So once I think volume will be start to picked up, then we will be the first one to get that benefit here. But second part, also like you said, this is industry GDP is growing like 7%. So is unproportionately is growing through service sector and other manufacturing, which is really we are not in that segment. Basically, if you see what industries we serving, this is really all impacted and continuously. Last year we seen lifestyle companies are not did well. This year is also they facing lots of challenges. So same way, I think consumer demand is important rather like growth in overall GDP, because there's also have different component of that. So I think we will be keep continuing, like we grown in a 17 to up to like 20, we grown a CAGR of almost once before that Corona time grown almost 14%, and then we in last FY22-23 we again grown 15%, and so that's way once this will be normalized, we will be grow. Overall industry is facing this pain for that growth numbers. But yes, you as mentioned, good thing is that we are not compromised on the margin, and margin level is also impacted due to like muted growth only, and due to not like operational things. It is operational cost is maintained, but other costs like salary and other admin costs is slightly bound to increase, and we don't want to be give like we want to be give the increments and everything to our like sales force and everyone.
Got it, sir. Thank you so much for the elaborative answer. That's it from my side, and wish you a happy Diwali to the entire team. Thank you so much.
Same to you, and wish you. Yeah.
We'll take the next question from Lokesh Manik. Lokesh, please unmute yourself and go ahead.
Hello.
Yes, Lokesh, please go ahead.
Yeah. Thanks, Naveen. Good evening, Murthy. Wishing you a very happy Diwali. Happy Diwali to the
Lokesh, your voice is cracking.
Hello.
Yes.
Yeah, is it better?
Yes, it is. Please go ahead.
Yes. Good evening, Murthy. Wishing you and the team a very happy Diwali. My
No,
question
Lokesh.
was,
Look, Lokesh is not helping. You're poor.
hello.
Yes.
Yeah, is it proper now?
Yes, it's better. Thank you.
Thank you. Mukti ji, my question was that a few quarters back it was mentioned that we had hired consultants for business strategy and expansion. So just clarification on that as to what is the expense that has come in on that side in the other expense for this quarter one. And the second is on what is the duration of their consultancy contract, if you can just share some details on that.
Yeah, very good. So basically, that consultant hired to how like expanding the branch network and all, and they already did work on that, and then they also given their reports where we have to be like more focused on that. So that we will be in time to come, but that is not a like big cost. We have not given like sometime we giving to other industry player giving to linkage with the like what kind of benefit we will be take. So, but we have not given on that way. It's a very not like significant amount, and yeah.
The duration of the contract, sir, when does it get over?
Yeah, that is get over. Yeah.
Okay, that is over.
Yeah.
Okay. Thank you so much and wishing you a very happy Diwali.
Same to you, please.
Thank you, Lokesh. We take the next question from Alok Devra. Alok, please go ahead.
Yeah, hi. Good evening. Am I audible?
Yes, you are. Please go ahead.
Yeah. So, just wanted to understand, you have also given a lot of details on the volume side. This mid single digit growth you are talking about is for second half, right?
Yeah.
Okay. Any reason why the price volumes are not coming? I mean, we are seeing some of the other players still clocking little better volumes, and also they are talking about price increase, which may not materialize entirely. But if we are also keeping the prices stagnant and focusing on ensuring that the volume growth is there, but still volume growth is kind of missing. So, just if you could, in a couple of minutes, if you can just highlight that is it a structural problem where competition is now increasing and it could sustain ahead, where volume growth is will remain muted ahead? Just some color on that, please.
Yeah. So as I mentioned, so basically there is no structural issues on overall basis. This industry is growing because there's a lots of opportunity for everyone, and as you may so basically I don't think everyone is facing the lots of challenge on a volume side, like whether it's a full truckload or whether LTL or express or I think except quick commerce, everyone has taking the bite on that. So we are not seeing anyone is increasing market share and we are losing the market share to someone else. That is not the case, and we will be still whenever other side of, if you see price hikes, everybody is saying, but it is not reflecting, I think, in their numbers. So they are saying because somehow supposing in one customer, we three players are working and one someone is asking, then other volume has to be, sometimes customer is not willing to pay. So we have not seen on ground at all anybody has increased the prices for any like logistic players. We have not seen at all in a ground. We don't know why everyone is saying, but it is a good thing. Supposing this able to do that, it is like it is easy for us to be forced to customer to be increase our prices as well. So once we are in a situation of wait and watch, because really we are not seeing that on ground. Once we will be reflecting this in their numbers, and obviously in customer prices we will be also able to find, but we yet not find. So we will be also do the same thing. In past we also did. No one has even able to do that, but we were able to do it because we doing on a realistic basis. Whatever possible we will do. So whenever these opportunities come and they will be able to do that, it is reflecting on customer side as well. Then we will be obviously push hard for that. Otherwise, no reason for that.
And sir, just one more question.
Yeah.
So we, around 2 years back, we had this thing of Gurgaon center getting automated, then eventually Pune will get automated, and more operational efficiency and more improvement in turnaround time and stuff, and which would see margin improvement. So at that point of time, you used to talk about 16% margin moving to 18%. So I understand this last 2 quarters were pretty difficult in terms of maintaining your base margin itself. But how do we see those impacts actually coming to the profits? Because those margins are actually not improving in line with what benefits were expected out of those centers getting operational.
Yeah, your concern is right, and we are also concerned about that. But if you see, good thing is there. Supposing we were not do the automation, then I think that margin is also not intact. So if you comparison with the others, what their margin has been reduced and what our margin is intact, because last year you see. So efficiency is a completely different part, and there we also get the benefit of, like I said, 25 basis to 30 basis point overall benefit we get from there. And that is would be like continue as a story, because this is ease out 3-4 thing as like labor intensity is down and efficiency is increasing, and obviously that benefit of reduction in waiting time of truck and all that happened, and that we will be keep continuing on that same strategy in future as well. But other side, if you see, like these all things put together, come together, like muted volumes is nobody has anticipated that much actually. So that is one part. Second part, like high increase of toll is nobody like anticipated, because government is now allowing to be increased to 8 to 10%. It is becoming significant amount for the overall journey cost. Third part, like because as a volume, labor cost is also government want to be standardized there and want to be increase their wages and all. So government focusing very high to be improve that side. So that is also like coming in one way. And because inflation is obviously government's purpose was to be keep demand slightly low to keep inflation, and that's why they also want to be reduce the consumption, and that happened in very that side. So that has a really impacted volumes. So put together, if you see, and now we even anticipation of this consolidation of airline, nobody has thought 3-4 airline will be like consolidated in one umbrella and they will be increase the prices. So that's put together has created a like this scenario. But still you will be appreciate that 13% margin or 14% EBITDA margin to achieving an express business is really is a good effort for from our team. And obviously we will be once bounce back with the volumes, we will be still have the same energy and same thought process and strategy to be get first to achieve like in the range of 15 to 16%, and then again increase on a higher side.
Also, all the best. Thank you. That's all from my side.
Thank
Happy
you.
Diwali to you and the team.
Thank you from our side. Yeah.
Thank you, Alok. We take the next question from Kripashankar NJ. Kripashankar, please go ahead.
Yeah, hi. Good evening and thank you for the opportunity. Sir, my first question is on the load factors. What we have seen clearly is that over the last 2 years, what was the 85% load factor? While volumes have grown from those levels of FY23, and we have our load factors at the truck level has declined. So are we deploying more trucks or expanding our services due to which, despite the tonnage growth, the utilization levels are lower? Is my understanding correct, or is there probably some other reason for these underutilization?
Yeah, so that is very good question. So what happened as over the period we converted all the truck on a higher axle load. So that was in FY20. I think there's the big most of the chunk we completed on FY23 only, and that was after that volumes has not picked up. So that's why this vacancy is there, slight 1 or 1.5% vacancies in comparison to those. Yeah, please.
Yeah, no, please go ahead.
Yeah, so basically that's why the only reason, because we added the converted these from the 9-ton truck to 11-ton and 14-ton truck to 18-ton. So that truck we can't be remove overnight because we're waiting for the volume. So once volume will be come, then that vacancy will be like reduced over the time. Further, also slightly change happened on the business pattern, like I think mentioned in last call, where south side and eastern side is really not doing well. They slightly have more problem in comparison to western part of India and northern India. So you are aware this half India is producing and half India is consuming. So that side is also really creating some vacancy for us, and it is if you put into number, then it is maybe like say 0.5% to 1% utilization has dropped due to that also.
Got it. So Muktiji, then wouldn't it be a decision to expand hubs in your regions? Can it be probably shelved or probably taken up at a later phase when growth is coming back? Because at this point, with growth not coming in and we are committing capacities expansion towards new capacities, it's putting pressure on our return metrics. So just your thoughts on what is the key reason for continuing this expansion?
So basically, there's two type of expansion is there. One of our branch network expansion, and other two like capacity expansion of trucks basically. So both are, if you see in in our case, as a to addition of branch, it is like a matter of we first analyzing and then opening up the branches, because these branches we are making break-in point within a 2 month of time. And so that's why whenever like volumes back, so we will be again start to be on a very fast mode. We still opening up the branches, but in a like slower pace, not like in a high pace. So is still going on, but once like volumes will be back, so we'll be increase the pace for the volume, this branch network. Second part, like whenever, because in our case, supplier side there is an overflow for that, so we never felt any challenge to be getting onboard our any supplier for the truck. So whenever we have the volume, we can be like onboard them. Otherwise, like as mentioned, like 90% volumes we carrying through these vendor guys, fixed this kind of like engaged trucks, and 10% volume we carrying through the sport hiring. So wherever we have the spurt in demand, so we can be hire more vehicles, and wherever supposing there is a low demand, we can be like not hiring than a sport hiring. So that's why I think this is not the challenge, at all on overall basis whenever we want to be. And also it is not like obstacle to be, our growth at all,
Yeah. So what I meant to Muktiji was on the hub expansion. So you are intending to take up hub expansion at new cities, right? So that is where probably most of our capital is going to, or capex is going to be tied up over the next 3 years. Is it possible to get that push until we see traction with respect to volume growth?
No. So basically, I think I'm not able to make you understand. So basically, capex is meant for more significantly for the sorting centers, construction and automation. That we will be keep continue, because we soon start the construction at Kolkata and Ahmedabad. All permission are now in almost completed. So I think in Q3 end or Q4 will we start the construction, and next year FY26 we will be able to complete the construction in these big two center, like each one is more in around 2 lakh square feet plus. So that strategy, long-term strategy is there, and we will be keep continue to be make that, because we like going to be buy the land in Mumbai and Chennai, and we working hard to be like on for Bangalore also. So 3-4 location we already working hard to be buy the land. So that strategy will be keep continue. I am saying, and for the like branch expansion, we don't need to be put on any capex kind of thing. Is like major is like opex, not the capex. And for the for truck supply is also like opex part, is not a capex part at all. So expansion, whenever we will be having the opportunity for the growth, we will be keep adding.
Thank you very much for answering my questions, and happy Diwali.
Same to you as well.
Thank you, Dipashankar. We take the next question from Kondinya Nimegada. Please go ahead.
Yeah, hi. Thanks for the opportunity. So a couple of questions. Firstly, if you can maybe provide a little bit more granular details on what are the key industries impacting the volume growth. That's on the first part. And secondly, in the current backdrop, what would be the revised capex guidance, say for FY25 and FY26? If you can give some color on that, please.
Yeah, very good. So basically, industry impacting major is highest one is like still continue to lifestyle companies and lifestyle and textile companies, and second one engineering companies, and third one now is unfortunately automobile companies are also not, they have slowed down their productions. And second part on capex side, if you divide in a like year on year basis, so FY25 we are anticipating because we will be start the construction soon. So I think we will be finished the capex in this year is around 40, in the range of 40 to 50 crore rupees for the whole year. And in the next year again a similar way, where we will be spending 100 and 125 crore in each year. Because in next year full-fledged construction will be start for these, will be there, and we might buy, we may buy one or two land parcel also, and similar way on a FY27 as well.
Sure. Got it, sir. So just a couple of bookkeeping questions. What is the number of branches and sorting centers that you added in first half of the year?
Sorry?
What are the number of branches and sorting centers that you added in first half this year?
So, this sorting center number we are not increasing. We just, as a long-term strategy, we just converting them from lease to own one. And specifically, like out of this 28, we want to be major one, which is in the number in 10 to 12 in all the big cities, and the handling in and out volume is almost like 75 to 80%. So we first want to be automate them, and out of that we already two fully automated, and next would be Kolkata and Ahmedabad, and I think FY26 or mid 27 we will be able to do that for these two centers, and followed by Chennai, Bangalore, Mumbai and all. So this will be, that is for the capex plan.
And how about the branches, sir?
And branches, we in this year we added almost like not much. It's 5 branches we added in H1, and this is also made for like multimodal products.
Understood. Mostly in the third quarter and second quarter. Understood.
Yeah.
Thank you so much. I'm done with my questions.
Manoj, please go ahead. Manoj, can you hear me? We move on to the next participant. Anshul Agrawal. Anshul, please unmute yourself and go ahead.
Hi, am I audible?
Yes, you are. Please go ahead.
Great. Thank you for the opportunity. Muktiji, my first question is on our pricing strategy. I see our realizations have sort of remained flat over the last 2-3 years. While in the current quarter, we have mentioned that our revenue contribution from SME customers have sort of tapered a bit. Shouldn't we think of reducing pricing for institutional customers to attract volumes at this point of time?
Yeah, so basically, this price is flattish in 1.5 year only, like in last year and this year, this first half only. Before that, in FY22-23, we were able to take almost, I think, 150 basis point overall basis. So that's the only 1.5 year, and because there's a muted growth, that's why we are not going for that. So second part, like supposing we will go for the institutional customer, as I said in earlier call also, there's no price war itself in this industry, because customer will keep the like 3-4 competition for the anyhow. Whether we will be reduce the prices, they will not be give the whole volume to us. They want to keep the 2-3 players to keep a competitive edge as there. And also sometimes this is not wise to be take the whole volume of the one customer, because this is giving a not good profit to us. As I mentioned, it is like gap in pricing with the institutional customer versus SMEs is also like 25 to 30%. So sometimes we intentionally keeping a like cap on doing the business with the big customer. That's why our margin is like intact on this testing time. Even still it is like maintained or slightly dipped. So I think this is not the, I do not think it is like right strategy to be cut the prices and get the more volumes.
Got it, sir. Second question is on the multimodal services. Are they still margin accretive in nature?
Yes. This is like rail and air and both are like very good.
And the contribution of these services to our overall top line would be still around 17-18% or higher
Yes.
than?
No, it is the same way. Yeah.
What
Okay. We also have in this space like B2C component also 2-3%. So that is also shrinking for us because we are not, going on a bigger players, and small players are like, so my B2C component is also like 3% in that. Earlier it was like, I think if you talk about 4-5 years back, it was around 5% of overall revenue. So that component you can say we are not increasing. So because we're dealing with the customer wherever we have the profit for B2C. So we're dealing with a small customer only.
Sure. Possible to share any color around what kind of margins would be making in these multimodal services or rail express business?
It's because these are the services where we are not utilizing our network basically from hub and spoke model. So basically hubs we are not using it directly point to point in case of rail or in case of C2C, in case of cold chain or in case of air. So that's why margin is good and is likely currently it is around in the range of 15 to 16% EBITDA level, specifically on air and rail.
Got it. Many thanks, sir.
Yeah.
That's it from my end.
Thank you, Anshul. Take the next question from Manjeet Buaria. Manjeet, please go ahead.
Mukti ji, thank you for the opportunity. I had 3 questions. First, I just wanted to go back to the industry structure, to get my bearings right there. If you could help me with how many people have entered the express PTL business in the last 10 years, and what are the number of players today in express PTL who you think are, good competition for you in terms of, like-to-like services which they offer?
Yeah, that is very good question you ask, Manjeet. So I think new entrants in B2B is 1 or 2 player which is really dealing with in B2B segment and they're not able to make the money. So they are entrant in that segment, and one company is acquired like other company that was also like old one. So I have not seen any much competition where they like getting market share or they like having a future threat for this industry. I don't see that. But if you see divide in that industry overall, it's like different multiple services and multiple products offerings. Each and every company has their own set of that. Like if you talk about, so in that layer, one is FTL industry, then is a LTL industry where they are not doing express but doing the LTL less than truckload. So there is an also overlapping sometime. They want to be our share also as an express share to that, but it depends on the customer whether they want to be lower prices or they want to good services. So that is like sometime class is there. Third thing is this third party logistic companies are there. So you name it, all our companies, they're doing inventory management, they're doing inbound and outbound. These are type of the company have different, and they majorly doing like I think this auto segment, warehousing and all major portion, I think I'm saying. And third thing is express industry is also having dividing in a 3-4 part. Like one is B2B, second B2C. Now the new entrants are this quick commerce and then courier companies. So each and every one is having a different product and a different opportunity for that. But if you see overall express industry in B2B segment on road side, where our presence and our, USP is there. So there is not much player, and our direct competition with the again is keep continue with the unorganized player, which is competing with us on a regional level basis and zone wise and all. So that's, I think that will be, it is really, I don't think it is like wise to be get the share from this unorganized player getting that business. That business we supposing we getting, then we will be ruin our margin profile. And also like credibility of that customer is also under question, and we may be like bad receivables in our balance sheet. That may be also happen. So we are very cautious. So if you see like 10-year data, our margin is continuously has increased. Our quality of balance sheet has improved a lot and is robust. And obviously we were like debt free status and giving continuous dividends.
Okay, but in terms of very like to like, as you mentioned on B2B express side, are
Yeah.
there like 3-4 players who are like close to us in terms of their network and in terms of their reach, and also in terms of, more importantly, their service quality, on-time delivery, and low damages or losses? So I was looking at how many number of players like that do you consider as your competitors really?
So yeah, it's a listed player which is having 2-3 player only.
2-3 players. Okay, got it. My next question, Mukti ji, was, you mentioned that you have taken calls between institutional customers and SME customers by maintaining a certain mix, which helps you keep certain healthy margins.
Yeah.
I was curious about, how does the management think about absolute profits? So, an institutional customer may be lower on margin, but adds to your absolute profit. And if you have like spare capacity to utilize, would you still let go of that business because margins could be lowered, or then you look at more absolute profit perspective and take on that business, as long as there is spare capacity which you are not taking away from SME?
You rightly said. So, supposing wherever we have a vacancy in truck, we obviously getting the, prices wherever, whatever price we can be get. Like I mentioned, it is from eastern part of India and southern part of India. Supposing there are any volumes, high volume, we are taking that. So I am not saying we are losing that, but somehow to see that, because if I'm again as a upward flow and like backward, this a return flow, this all depends. Supposing I have the more business from the like in upward flow, then you have to be lose the money anyhow if you will not be able to fulfill that truck in return load. So that's why we have opened up the branches, and that's why these branches helping us, because in some time in these part like down south and upper north and eastern part of India, there is no big businesses are there and no manufacturing is there. That's why we opened up branches to be fill these trucks wherever we sending. So this is a strategy, because we are not like charging for the absolute profit, but it's the mix has to be there to maintain my utilization level of truck is very important for us. This is directly, supposing I am lose that proposition, then my there will be taken a hit on my margin levels.
Okay,
For sure.
and one last question.
Because I am saying, why I am saying, because these are the, in one truck, I am putting 200 customers, business, not the like I am depending on a one customer. So that's why I think is not the like a high volume will be help to be, getting the profit. This is not the like, mandatory thing, or not the like, sure things I am saying.
Got it. I had one last question. Assuming that our cost levels remain where they are, and your mix between SME and institutional stays where it is, right? Two big items, right? At what volume per year, and at what utilization should that volume happen for us to go back to 15-16% margins? So I'm telling ceteris paribus, all else remaining equal. What should our annual volumes and utilization rate have to be to go back to about 15-16% margin?
Yeah, so this is a very in simple way. I supposing tomorrow we will be grow in the range of 10%, then we'll be back to normal in a 15% place kind of EBITDA. We will be back to that.
So 10% value growth basically
Yeah.
is to go back to that.
Yeah.
Okay, Mukti ji, very helpful. I'll take other questions later. I think we are past that time. Thank you.
Thank you.
Thank you, Manjeet. Friends, we take the last question for the evening from Akash Vora. Akash, please go ahead. Akash, please unmute yourself and go ahead.
Yeah, I'm audible.
Akash, there's a lot of disturbance and your voice is cracking.
Hello, yeah, is it better?
Yes, it is. Please go ahead.
Yeah. So, Mukti sir, you were mentioning earlier in the call that, from certain base level inquiries and interactions with your customers, you're understanding that, they're giving you strong volume growth guidance in the coming year, that is FY26. So, what is the
Sorry, can
volume
you
growth?
repeat again? I just missed the last 2-3 line. Can you just, yeah.
Yeah. So you were mentioning that, your through your customer interactions, they were promising you certain amount of volume growth coming in FY26. So what is, in what range are they promising? Like what kind of growth are they committing?
So basically, so as we focusing on 3 part. One is we putting separate sales, more sales people on the ground to be getting. So we want to be in a balance out of here. One is more focus on an institutional customer to adding new customer, all the competition customer. Second part, we already have opened up the branches, so we want to be in a more share from the SME customer. And third thing, we want to be enhance the customer base in obviously in multimodal product also. So we put together 3-4 strategy. We want to be like growth and supposing we have anticipation to be grow 13 to 14% in volume side. So 7-8% volume will be come from the existing customer, and then remaining will be come from the new addition customer. So that's our strategy, and that's why we working on the ground very hard to be and people are on the street, and we focusing how we can be go to door and ask for the business, because this business is not to be like where we sit in our office and people will be come to us. Rather we have to be go on their door and ask for the business. So that's we making efforts and enhance our footprint to be get more business, and sales team has increased for that.
Got it, sir. Sir, two numbers, if you could quantify, what are the new customers that how many new customers we have added in this 6 months? And secondly, what is the top 10 customer concentration in our revenue for this first 6 months?
Yeah. So basically, revenue constant, if you see my top 25 customer has not giving more than 15% revenue to us. And number of addition, I'm just not remember for that. So 1 to 1, I can be give that numbers. I'm just really not remember that number right
now. Sure, sir. No problem. Yeah. Thank you.
Thank you, Akash. Friends, thank you for your active participation, but we've run out of time completely. And I take this opportunity to invite Chandar or Mukti for their closing comments.
Yeah, Chandar sir, you would like to say something on that? Okay. So no worry. So thank you everyone. I would like to thank everyone for joining on the call. I hope you have been able to respond to all your questions adequately. For any further information, we request you to please do get in touch with our investor relation team. So stay safe, stay healthy and happy, and Shubh Deepavali to everyone. Thank you once again for joining with us. Yeah.
Thank you very much. On behalf of SKP Securities, I'd like to thank Mr. Agarwal, Mr. Muktilal, Mr. Srivastava, and Mr. Pandey for the time to interact with the investors. We look forward to hosting you again in the next quarter. Wish everyone a happy Diwali and have a wonderful evening. Thank you.
Thank you. Thanks a lot, please.